Good afternoon, everyone. Welcome to today's LinkedIn Live. I'm Linda Carrington and I'm with Graham Potts from Wessex Commercial. He's our Managing Director and a whiz with numbers, which is great because today we're going to be doing things a little bit differently. Often we don't really understand what goes where in our accounts, so the balance sheet, P&L, and how that relates to cash. Graham's going to run through a worked example to show you exactly how those three statements link together. So ask if you've got any questions as we go along. But Graham, I'm going to go straight over to you today.
Yeah, thank you, Linda. We're going to go through this worked example, but I would emphasize a couple little caveats. It's very quick. This will be downloaded or put up to our website and be on our YouTube channel, hopefully this week. So you can look at it again. It's being recorded. So that's number one. Number two, it does not include VAT. I thought that was too complicated to do, so we just keep VAT out of it for the moment. It's also a year's transactions all in one go. So like, for instance, if you've got sales, when we go through sales, it'll be 50,000, but that wouldn't happen in one tranche. It'll be through the year, but we're doing a year's bookkeeping to show you, to give you an example of what happens and where things go.
Excellent.
So if we pull the slides, so we're calling this Joined Up Accounts Limited. And what we're going to do is going to run through some scenarios, bookkeeping scenarios, and then we're going to show you where it goes. So it's going to be very, like I said, quick, and it's on one sheet, but we have to keep on coming back to it. So Linda, if we go to the first transaction. So we're looking at a startup company. And what we're saying is we've actually invested. I mean, most times when you have a startup company, most companies start up with a couple pounds or £100 of share capital. But we're going to go for 5,000. So we're investing 5,000. We're paying 5,000 into our bank. And we're saying all the banks set up and everything else, the company's all set up. So £5,000, we're putting of our own money into the company. And that is as shares. So we've bought 5,000 ordinary shares in the company.
Sure.
And what that happens is what we've done is we set out this scenario, this sheet you can see will continue right through. So we're going to keep on coming back to this sheet. So the 5,000 we're putting into the bank. So that's increasing the cash in bank. And it's called 5,000 is share capital. So it's actually you're buying shares. So you've bought something. You're not in this example, we've not put it in as director's loan.
Okay.
So then, because we've got some trading, we need to borrow some money. We've borrowed £8,000 from the bank over 2 years. The interest rate is 10%. So at the end of the first year, what we're saying is that the interest will have to be paid, and also there'll be a loan repayment. Now, the loan repayment obviously is, if it's over 2 years, is £4,000. It's half of 8,000. And the interest rate, 10% of 8,000, we kept it simple, is £800. Now, this would, again, be one of those transactions you'd be paying so much. If it's over 2 years, it'll be paying monthly, but we're just putting the whole lot in as one. Okay. So if we go to the example, please, Linda. Right, so first of all, we're putting 8,000 into the bank, and we're creating a loan of £8,000. Then it comes up, we're actually repaying £4,000. So that's coming out of the bank. And that means that the loan is also reducing by £4,000. Next, we've got the interest. We've got to pay the interest. So the interest is £800. That's coming out of the bank. And the interest basically is a cost to the profit and loss. Whereas the loan repayment and the original loan are in your balance sheet as a liability.
Okay.
Right, then we've purchased a computer, printer, software, etc. for £4,500. We've estimated the useful life to be 3 years. So we're doing it on what's called a straight line basis, which most companies use now, rather than what is called reducing balance, where you do it on the reduce it every year. So for instance, if it's 4,500, the first year, whatever you use will be, if it's at 33%, which is what we're talking over 3 years, both of them will be 1,500. But the next year, if it's reducing balance, it will be 3,000, which is the net book value. But we're not doing that. We're writing it off over 3 years. Now, I would say, again, another caveat, depreciation is not got anything to do with corporation tax.
Okay.
So that's a myth out there sometimes that you hear in the pub. It's got nothing to do with that. Tax is totally different to this. It's just to allocate what they think is an asset which has got a useful life over a year over that period of its useful life.
Yeah. Okay.
So going into this, sorry, Linda, yes?
Yeah, I was going to say, let's see where the figures end up in here.
Yeah. So basically, we're buying an asset of £4,500, and that goes into your assets in the balance sheet under plant and equipment. It also makes me think it's protective clothing, but it's not. It's plant and equipment. And then we've got £4,500 coming out of the bank account. So we've actually paid £4,500 out for this equipment, for the computer, etc.
Yeah. Okay.
And then at the end of the year, well, if you've got bookkeeping, you'll be doing it through the year. But basically, we're depreciating it over 3 years. So we reduce the asset by £1,500.
Yeah.
And that is a cost that will go to your profit and loss account. So the other side, because it's double entry bookkeeping, so you have to have it's a balance. So you have to put it another transaction that comes out of your profit and loss account. It's a cost that will come off your sales.
And can I just throw in a little question?
Yes.
Graham? When you talk about the double entry bookkeeping, that's a transaction that you've got that equal sign in the middle. That's key to this, isn't it?
It is. I mean, basically, what we've got here, we've got assets equals your liability plus owner's equity. We could actually go and say, it could be assets minus liabilities equals owner's equity. Yeah. That's the other side, because it's actually the same. Yeah. All you're doing is you're just moving the equals. It's, so, but what we're trying to do is it must always balance. And that's what happens, because at the end, we'll have a balance sheet, which will be your assets less your liabilities. And that will equate to your owner's equity, but we'll also show you a cash flow statement and a profit and loss statement.
Yeah. Okay, let's carry on to the next one.
Right. So during the year, we've purchased £15,000 of stock.
Mm-hmm.
We've sold it for 2/3. Well, sold 2/3 of it, but we sold it for 50,000. We got it at a very good rate. And at the year end, because we were giving trade terms to our customers, we had been paid 31,000 with £19,000 outstanding. Mm-hmm. So we had age receivables, or what's called trade debtors, of 19,000. Now, in our books, we also, because we've basically, when we purchased the stock, we put it to stock because we haven't sold it yet. Yep. That's a balance sheet item. When we've actually sold that stock, we have to move it from the balance sheet and put it to the profit and loss account. So basically, we will reduce in our books 2/3 of the 15,000, which is 10,000, will come out of the balance sheet.
Okay, let's see where that goes.
So basically, to start with, we had 15,000 that we've come out of our bank for the stock, and it's an asset we've purchased. That's the 15,000. Next, we basically have sold 50,000. So 50,000 goes into sales under retained profits. But because we haven't had, or we had 31,000 in cash and 19,000 is still owed, 31,000 goes into the bank, and 19,000 is still there as age receivables at the year end.
Yeah. So that's, and that, I took me a long time to get to grips with that term, age receivables and age payables, but essentially it's people that owe you money are the age receivables, aren't they?
Yes, and age payables is people that
your invoices that haven't been paid yet.
Yeah. And usually they're suppliers, they're trade terms.
Yeah.
There are other items that go into the balance sheet, but that's when you have, it's your customers and your suppliers.
Yeah.
And then, as we said, we have to reduce our stock by £10,000 because we've sold 2/3 of it, and that reduces the stock in the balance sheet of the asset of 10,000 by 10,000, and it is a cost to the retained profits, the profit and loss account.
Yeah.
Then we're going to go through the overheads, and we're saying cost for rent, office supplies, payroll, and advertising, 18,500 for the year. We have paid 16,500 out by the year end, and we still have 2,000 outstanding to suppliers, which will be age payables. So the initial one, so what we're showing is that we've had 18,500 of costs, so that goes against your retained the profits, the profit and loss account. Then we've reduced our cash by 16,500, our bank, because we've paid that out, but we still owe 2,000 at the year end. So that is an aged payable. So we've put 2,000 into aged payables.
Yep. And then the profit.
Right. Then we've estimated corporation tax at 4,000. We would do a corporation tax comp, and that is not part of today's discussion. So we're estimating it so that we can get a better value of our profit and loss account, because you will have to pay that usually 9 months after your year end.
Yeah.
It can be different in a startup. Depends on when your year end or your period end is. But if we move to the slide, and what happens, we basically accrue that in the liabilities. We say that's a liability you've got at the year end that you're going to have to pay in the next year. That's £4,000. And that 4,000 will also come off your profit and loss account.
Okay.
And then towards the end of the year, we wanted to pay ourselves a 10,000 dividend. However, at the time, we didn't have enough cash. So we paid ourselves 1,000 of that dividend and leaving 9,000 outstanding. But we did declare the dividend. So it goes into this year's accounts.
Okay.
And those for, obviously dividends is, a lot of people that are looking at this will be paid probably a mixture of salary and dividends.
Yeah.
So this is why we're, we separate out the dividends. Now, the 10,000 will come off your profit and loss account. You've still got 9,000 due to you. So that goes in as a liability. It's a liability for the company because the company owes you £9,000. And £1,000 comes off our cash. Often, you find that businesses have taken money out, or director shareholders have taken money out during the year, in which case their director's loan account will probably be overdrawn. Because if it's a personal expense and it's not through payroll or dividends, it goes to the director's loan account. And this often reduces your director's loan account owing. Be very careful with director's loan accounts. You can only pay dividends if you've got retained profits. And also, if you think you're paying yourself a dividend and you haven't got retained profits, it will end up going to your director's loan account and you will owe money to the company.
Yeah.
So be very, very careful on taking money out of the company.
Yeah. Okay. So let's bring it all together.
Let's add it up.
Yeah, let's do it.
Right. So along the bottom, our assets, you've got 2,200 of cash. Age receivables, you owed 19,000. The company is. The company has 5,000 of stock, and it's 3,000 net assets, net fixed assets. That totals 29,200 if you do the maths. Then under liabilities, you've got 2,000 you owe for your suppliers under age payables. You owe the taxman 4,000 for corporation tax. Your loan has been reduced from 8 to 4,000 from the 4,000 repayment. So you've got 4,000 of loans still to pay. And the company owes you £9,000 for dividends. That totals 19,000. Then if we look at that from an equity point of view, you've basically put in 5,000 of share capital. Then if you look at your retained profits or your profit and loss account for this year, you've got 50,000 of income. You've got cost of sales, which is the stock you used, of 10,000. You've got overheads, operating expenses of 18,500, depreciation 1,500, interest 800, tax 4,000, dividends 10,000. They come off your profit. And a word of warning: if ever you're looking to sell, companies will add back dividends. They're looking at pre-tax profits, and often they're looking at EBITDA, earnings before interest, tax, depreciation, and normal amortization. So if you're looking at a company, you've made, say, 150,000 profit as a company, and you've paid yourself 50,000 of dividends, that 50,000 will be added back from their calculations on a multiple of profits usually.
Yeah. Yeah, definitely. Okay, so let's look at the individual statements then.
So the profit and loss, we've just been through those figures, which is down the right-hand side. Mm-hmm. And then we'll just show you a profit and loss and how that comes about. So that's when you get a profit and loss. So you've got your income of 50, your cost of sales of 10, so your gross profit is 40. Mm-hmm. Usually that's one key performance indicator. You would look at 40 over 50 is your gross profit percentage, which in this case would be 80%. It's not up on the slides. You reduce your operating expenses, your overheads and depreciation. Then you get your operating profit, which is 20,000. Then you take off your interest, so your net profit before tax, but after interest is 19.2. Mm-hmm. Then you've got your tax and your dividends, and so your retained profits are 5,200. That's what's retained in the business to carry forward into future years.
Okay.
The cash flow statement. That's the cash is along the left-hand side. I'll run through it when we show you the actual cash statement. So then you've got your opening cash, which in this case was nil because it was a startup. The money you've had from your customers, 31,000, accounts receivable. The amounts you've paid out for stock, 15,000, and for overheads you've paid 16,500, and you paid your interest, 800. That is your total operating cash flow. So your operating cash flow is negative.
Yeah.
Then you've paid for fixed asset investment. That was the computer and software. That's 4,500. So that's investing cash flow. Mm-hmm. Then you've got your financing cash flow where you've put 5,000 in for your share capital, financing from the bank, less the loan that's taken. So that is a net figure of 4, and the dividends you've taken out. So your total financing cash flow is 8,000. So your closing cash is 2,200.
Okay.
And here's the balance sheet. The balance sheet is all on the bottom. So if we move on to the next slide. So the balance sheet basically has got your banking cash. So this matches to the sheet that we were just been through. Mm-hmm. So you've got 2,200 in your bank account. You've still owed 19,000 from your customers. You've got stock of 5,000. Your fixed assets less your depreciation gives you net assets of 3,000. Mm-hmm. So your total assets was 29,200, which was in that sheet that we showed you.
Yeah.
Your liabilities, you've got 2,000 that's owed to your suppliers. You owe the taxman 4,000. You owe the bank for your loan 4,000. Mm-hmm. And the company owes you or the shareholders, whoever they are, of 9,000. So there's 19,000 of liabilities. This is then the 19,000 is deducted from the 29,200 to give 10,200 of net assets less liabilities. Mm-hmm. The reason it is called a balance sheet because it balances your stake in the business, which is your share capital you put in, your ordinary shares of 5,000, and the profit that we just went through after tax, after dividends of 5,200. So it matches your equity in the business of 10,200.
Okay.
And this is why profit is not cash. So if we look at this sheet again, you've got the cash, and down the left-hand corner is your balance of cash. Mm-hmm. And on your right-hand corner is your profit. So your profit is 5,200, but your cash in the bank is 2,200. And the reason that profit is not cash is because you've got assets that you've paid money for, or you've got money, sort of like trade debtors, you've got your stock, you've got your fixed assets. That is the reason, less your liabilities, which are your age payables, your taxes, loans, and dividends not paid yet. But that together means that your cash will never, hardly ever equal your profit. Now, in this instance, I also want to show you, if you hadn't paid a dividend and we added back the cash of the dividend as 1,000, you'd be 3,200 in cash, but your profit before dividends is 15,000. So that's nearly a £12,000 difference. Mm-hmm. And with this, and we've done it in previous LinkedIn Lives, this is why you need to really look at what stocks in your business, what your age receivables are, and make sure you've got a robust credit control policy and you're getting that money in as quick as possible. You're not giving, too long terms.
Yeah.
You actually, you look at what the norm is in the industry, but also you look at what you can accept and how your customer wants you. Because if the customer wants you, they will probably pay to whatever terms you want within reason. And then, so you look at also your fixed assets to make sure that are there any assets that's not utilized in the business that you could sell. All these things are on previous LinkedIn Lives. But really look at your assets and make sure that you're maximizing them so that actually you get as much of those age receivable stock, equipment, actually turn it into cash as quick as possible.
Yeah. I'm just want to pick up on how to increase the cash. I mean, the credit control side of things in my mind is really key as well, is making sure that, as well as not giving terms that, that are unnecessary, use the, think on Xero, for example, use the reminders, make sure that you are following up unpaid invoices, and you understand why they're not paid and when you're going to get paid for them.
So yeah, Linda, I was going to say, and if they're very large invoices, make sure that you've got the process right, that the invoice that you check when you sent the invoice, that they've received it, that it's going through the process, and you follow that up to make sure it's on the right payment cycle. Because big companies will often wait until the payment deadline, and then say, you've missed off, you haven't got an order reference, it's missed the cycle. So just make sure that you actually invoice correctly with what the customer requires.
Yeah. And one of the things that strikes me, and I don't know what your tips are, Graham, is we can see here that profit and cash are not the same thing. How does that change as you grow your business? This is like a year one snapshot. What happens in years 2, 3, 4, 5?
Well, often what happens, if you grow, and especially if you grow fast, you need more cash.
Yeah.
Because your stock and your age receivables often go higher and higher. And if you grow fast, what happens is that actually you're not converting them around quick enough. I've seen it with businesses that have got high, age receivables, retentions, for instance, in the construction industry, high stock, maybe high work in progress. Mm-hmm. What you've got to realize, you've got to look at that as you grow fast, or, as you grow, you've got to make sure you've got the cash in place to grow. Now, sometimes with this fast growth, you do need to look at alternative financing, things like invoice discounting, maybe, or other things, or maybe, stock holding of your, you might be able to get some credit on your stock that you hold, etc. But always got to look at, I see so many times when businesses grow and grow fast, they don't understand. They've made, say, 100,000, but they got no cash in the bank, and they don't understand. Yeah. And it's all about this working capital. It's minimizing the age receivables, the stock, as much as you can, and maximizing within reason your age payables, etc. So see if you can get extended terms on your stock. Maybe you can get a retention of title on it, so that actually you can get people to hold the stock for you, and you're not paying for it until you used it. Mm-hmm. As you get better, to start with, you've got no chance usually of that. But as you get more and more established, businesses might look at that. So there's things to consider of how much working capital you need, especially if you're growing fast.
Yeah, definitely. So, Graham, if people are looking for an FD who can explain finance concepts in simple terms, and help them understand how they can get the results that they want in their business, you're offering a free one-to-one. Is that right?
That's correct. Yes.
Yep.
Yes.
So pop an email over to chatwithgraham@westsexcommercial.com and we'll get a time set up. And next time, if you've ever wondered how you can measure your carbon footprint, this is the session for you. We're asking, we're looking at how your business can make a difference without greenwashing. So join us on the 8th of April. We'll be showing you how to use Xero and Ecology to understand your carbon footprint. So I look forward to seeing you then. And thanks everyone for joining us today.
Thanks very much. Goodbye.